Welcome back to another weekly episode. So, the first slide I'll put up is what happened in the US. That is on Friday. You saw a sharp sell off, especially in the tech sector space, AI related trade. Dow Jones was still down, I think, about 1.3%. But in general, VIX was up about 30 odd percent, S&P 500 was down 2.6%, and mainly NASDAQ was down 4.2%. So, before I come to the topic of the video, we'll just first understand what is currently happening and then I'll link it up with whatever is happening in the Indian market. So this was the worst day for stocks since October. A lot of market cap went away in one single session. This is something we have discussed in our last video also about a crowded trade that I was explaining, and why emerging markets are also in particular at a huge risk kind of point when it comes to the AI trade. Of course, when things are going well, nobody wants to see the probability and the possibility of such sharp reversals playing out in the market. But again, history teaches you that these things happen on a periodic basis. So Nasdaq was down about 4.2%. VIX was up 30%, $1 trillion or more market cap went away. So what actually triggered this? There were actually four data points. All right. The first one was hot jobs report. Reports came out, 172,000 jobs were added versus expected 88,000. So that prompted a lot of people to say that Fed will go ahead and hike interest rates, especially with whatever is happening in the global supply chain. I personally doubt it, but I'll come to it when the dedicated Fed slide comes out. The second was, again, the AI semiconductor space. So these 2 points are interlinked. You are seeing a lot of reports where even Americans are pulling out money and putting in the South Korean and the Taiwanese market. By the way, whatever happened in America on Friday, that is yesterday, I think Monday is going to be absolutely brutal for Taiwan and South Korean market. That is my take on it. I may be completely wrong, but this is what happens when there is a lot of leverage in the system. I'll also speak about India in a bit. So the semiconductor space obviously saw a lot of pullback, and I will use the word pullback because it's very easy to say this is beginning of a crash and those kind of things. I don't want to sensationalize what has happened. We'll take it 1 week at a time. Currently it looks like a pullback, a sharp pullback, again because it was a crowded trade. There were some statistics I put out in last episode. I'll put out some statistics today also. And then there are this wall of supply. A lot of new issuances are coming up, IPOs are coming up, companies, the existing ones, are raising money. So this also impacts overall sentiment. So while macro was a trigger, that is jobs, a new Fed is going to have its first meeting, I think, on 17th. Treasury yields had an impact. Again, 4.54%. The 10-year, I think the 30-year was just at 5 or above 5. I don't remember. But this is one of the reasons why a lot of people got nervous and started dumping stocks. The main thing is the semiconductor chip AI trade. So Marvel was down 16%, Micron 13%, Intel 11%, AMD 11%, Broadcom 7%, Nvidia 6%, IBM 5%. So this is a crowded space. All right, this is what is the reason why India has been criticized so much, that we don't have a AI play, we don't have semiconductors, we have missed out. So whenever there is a crowd that rushes towards a particular trade or a particular gate that I showed you in the last week's episode, these things happen. So don't jump to conclusion that this is the end of AI trade. No, it is not, but it has potential to significantly impact global market sentiment. So the tech sector alone has rallied 50% plus. Intel alone 250% YTD. I've already shared the data with you last week where the Korean market itself is up 80%. I think 240% in 2 years. So these things were so one-sided in terms of anybody wanting to come into the market and starting to invest in this particular theme, that the writing was there on the wall. And I think some of our Indian influencers have also jinxed this trade because they were coming up with so many data points that you should not be investing money in India and you should be taking money abroad and putting it in the AI theme. So probably a couple of them have also kind of jinxed this trade. Now, a lot of new share is coming in the market for Alphabet, for Meta, for Broadcom. So what happens is whenever new issuances are made or IPO comes out, it sucks liquidity out of the system. For those of you who have been tracking market for a long period of time, this happened with us also. I think in 2007-8 when Coal India came out, or was it Reliance Petroleum that came out? I don't exactly remember. But periodically you will see whenever the markets are doing exceptionally well, then the market leaders come out with new IPOs, and that actually sucks a lot of liquidity out of the system, and people have to pull out money from somewhere, and probably that is also one of the reasons why this has happened. You also should not forget that the biggest IPO wave is coming in the US. SpaceX on June 12. Then you have Anthropic, OpenAI. So all these new issuances are going to come up, that is IPOs are going to come up. Again, watch out. During this particular time, a lot of our influencers will come out and say why you should be investing in these companies, which is completely your call. But in general, I will tell you, don't take individual stock recommendations from anyone. You've already seen this week and the week prior to that, a lot of companies have not done well in India. A lot of companies once traded at 1,000, 2,000 are now down to like 100, 200. Whenever someone is issuing you recommendation about a particular stock, always follow up, because it is very easy for these guys to just give you a recommendation, buy XYZ, and they just forget it. You pay them hefty fees, hefty subscription cost, etc., etc. But when the stock begins to fall, that is when you run into trouble. So do your own research. It is not that difficult these days to understand about stock markets, to learn about stock markets. In the comment section, I've given a list of books you should be reading. Take control of your money. If you still don't feel confident, mutual fund is there. If you are relatively confident but are new, then try with ETFs. Then you can get into stocks. But getting stock recommendation from somebody or some entity is something I never recommend, unless and until they have a track record of following up with what happened to their recommendation. That is being very honest about it. It is fine for an analyst to go wrong, but you know how the industry works. Recommendations are given, and then there is no follow up on that. So, to summarize what happened, there were three pressure doors: the rate shock expectation, which I personally believe will not happen; crowded positioning, this is something I've spoken about in my last week's episode; and of course, the new supply that is coming in the market. This is a big headwind. This has always played out this way, and that is why we had one of the worst sessions in October. In general, I was reading a lot of news articles after markets ended on Friday. A lot of people are saying this is a potential dip and it's an opportunity to accumulate. I won't disagree, because between the 1992 and 1999 dot-com boom, there were several instances where NASDAQ fell a lot, where internet stocks fell 20, 30, 40%, and it turned out to be a great buying opportunity. So whenever some supply goes out of the market, probably in the next quarter, US markets will again stabilize and you'll again see some of these names moving up. That is how things work. But this is a wonderful shakeout that is happening in the market. So, what data points you need to watch for when it comes to US markets? Why US markets? Because if relentlessly US markets keep falling, it will become very difficult for our markets also to hold up. First is the 10-year treasury yield. I will also add the 30-year. If it keeps sustaining above 5.1, that is trouble. And equity markets don't like that. Then the 17 June Fed meeting. Kevin Walsh is going to, I think, deliver his first kind of speech. His tone will be important. I don't think anything negative will come out, because he has been hired for one particular reason by President Trump. I don't think he'll disappoint him. So for me, this is a non-event unless and until there is some big surprise coming. The SpaceX IPO. I think people are just going crazy behind this. And it might do what Facebook or Meta did when it listed. Initially, it listed, went up, and then it went into a 30, 40% correction. And then over the years, it started doing well. But again, it is going to suck out a lot of liquidity from the system. Then the semiconductor play, whether you see stability returning here or not. This is a pocket where there is massive leverage. And I'm sure this weekend, a lot of people will start remembering Warren Buffett, that don't take leverage, don't forget rule number one, and all those kind of things. Whereas this is something that was blindly happening in the US market, AI trade. A lot of our influencers were also recommending this blindly. VIX has jumped up a lot. I think it is above the 20 mark. You need stability there, else it is going to spill over to other markets also. I think Nikkei was also down. That is, Japanese market overnight was down, I think 3.5%, 4%. The real thing that is going to play out on Monday is Korea and Taiwan. I'll come to that when I speak about emerging markets. But in general, geopolitics also is not shaping up well. This is something that we are getting used to, because this is a era, or maybe multiple decades, when peace is not going to be the norm. So Friday's fall, again, primarily a strong jobs print. Again, if it were not a crowded space, that is AI semiconductors, market would have ignored this. But what generally happens is, whenever people want to take profit off the table, then they make a particular news point and issue, and they react on it. My personal take is that it was mainly because of semiconductor AI trade plus the wall of supply that is coming. Now, why crowded trades are dangerous? Now, this is a point I made in last week's episode also. There were some people who did not agree with me, but always remember, whenever something is going up in a vertical manner, I tweeted about this also 10 days back, that things that rise exponentially have to come down. All right. You saw it with crypto. Bitcoin at 126, today it is what? 60,000. Ethereum again, 5,000 it was. Today it is what? 1,700. Gold, silver, I mean, down 30, 40% whenever a lot of buy calls were being made about it. The same thing is happening in the AI and semiconductor space. So nothing escapes gravity in stock markets. And especially when you start seeing people selling off stocks and certain assets and then shifting to Korea, Taiwan to invest their money, people in India who know nothing about what is happening in the American economy suddenly becoming experts and advocating to have diversified positions, go and take a bet in AI space. Fund managers who were a couple of years back going gaga about the Indian growth story suddenly starting to find fault and now telling you that the AI story is a great story, American story is a great story. All these are telltale signs. Always remember that. That is why focus is important. If you understand India, be in India, invest in India. There are a lot of opportunities. Some slides I'll put up. Now, what happens to India on Monday? So first of all, I would tell you stop thinking about Monday, Tuesday, Wednesday, Thursday. Otherwise, you will always remain in this short-term news cycle. Think from couple of quarters down the line. What I would tell you is that emerging markets year to date is up 25%. All data is in USD. United States is 11%, world markets is 11%, India is minus 11.2%, which means we don't have a crowded trade here. We don't have a lot of money here. People have made nothing. 5-year USD return is zero. Whatever gains we have made is in the SMID space, even since March 2026. So some hit is definitely going to be there, but we don't have that trigger that there can be massive sell-off that can come. Sentiment-wise, yes, rate sensitives will take a hit, but otherwise, relatively, I think we should be okay. Downside will happen, let me tell you, because if US starts wobbling like that, it's the mother of all stock market. Indian market will also bear the brunt. So we have already derated a lot. We are lagging. We don't have major AI themes. Plus, there is a lot of good news when it comes to RBI for what it has done. I'll come to this slide also in a bit. So in general, when it comes to India, largely the bad news that had to play out for us, it has played out. Yes, sentiment wise, we will get impacted. There is no doubt about it. There are some positive developments also that has happened, particularly for India. I'll speak about that in a bit. So now this is about India's percentile rank in the EM basket, that is emerging market basket. First, I'll talk about this particular chart. See, India's percentile rank, if you look at the performance in emerging market basket today, it is similar to what we were in 2011, 2012, 2013. Not great. We've seen so much of underperformance, so much of outflow. If you look at this number, about 85% emerging markets have beaten India in 2025. In 2026, actually, this number is 90% what we saw in 2011. So understand one thing, even if there is a large sell-off happening in the US market, Korean market, Taiwanese market, I would tell you a couple of quarters down the line, that is actually positive thing for India because India has such limited allocation currently in the emerging market basket. Yesterday, our GDP numbers came out. Again, 7.7, 7.9%, fantastic. People will doubt about it. That is fine. It is their outlook. Let them think what they want, as if they are the only people who know that things are fabricated. And DIIs, FIIs, large market investors, large traders, pension funds, all are stupid to believe that this number is accurate. Sometimes the arguments that you hear online are so illogical that please don't pay attention to this. All right, people have their own perception of their own reality. Let them say what they want to say. There are billions and billions and billions of dollars invested in India based on the statistics that governments have put out over the last 26 years. But a couple of people will come and write, this is fabricated. Please don't fall for all this. This is all garbage. Always remember one thing, that news flow, whenever things are not doing well, will always be worse. Right? Always remember that. So currently, India is just not in a great position when it comes from stock market performance point of view. And I don't think that this is going to reverse so soon also. Things will always get worse before it starts to get better. And next is one word about the GDP numbers that came out. Our problem is not the GDP growth. It is the nominal GDP growth. That is currently not great. Government is taking steps, RBI is taking steps, but it is going to take little time. That is the reality of it. So current allocation of India within MSCI EM is 11.9%. Okay, Taiwan 25%, China 23%, South Korea 19%. I think these two markets are at heavy risk. This is something I explained in last episode also. Now look at what is happening in terms of concentration. Top 4 countries in emerging market in 2016, 2017 had a concentration of 64%, which means only in top 4 countries itself, 64% emerging market funds were there. Look at that number today. It is 80%. One stock has 14%. And that is why look at what emerging market basket is doing. The kind of wide range candles that are getting printed on the downside, because this is a big systematic problem. which again I highlighted in my last week's episode, and read some of the comments that were there. Because data and reality is what generally people don't want to see. India is not the risk currently. India is not the risk currently because we just have 11.9% ownership. I think historical low for India is 8% ownership or 7.5%. We might go there. So we might see another 20, $30 billion outflow also. That is going to happen. But RBI is also taking counter steps for that. I'll come to that in a bit. India is not the risk today. India is already underperforming, already underowned. So risk is not there with us. Risk is there in South Korea. Risk is there in Taiwan. Risk is there in the US tech sector, specifically AI and semiconductor. We know what is happening here. We are not getting returns. We are not getting money. SIPs, our domestic institutional investors, are helping out the market and keeping the market afloat. India is trading at a premium. I won't deny that, but that premium is relatively justified also. Again, if people want to focus on data, not narratives. All right. Next slide I'll pull out is sector composition and why, if the AI trade actually is going to face some trouble in the next couple of quarters, India will be relatively safe. So, where is the concentration sector wise in emerging market? First, it is in infotech, mainly AI semiconductor, 37%. Next is in financial, 20%. For India, this is not such a bad news because India, 30% financial sector representation is there. And financials have just not done well. Who is owning banks? Who is investing into financials? Things are down so much. Bank Nifty, along with Nifty, is one of the worst performing sectors in the market. So, ownership of banking and financial in this particular Y2D, where things have not done well, is relatively on the lower side. Why is India not done well? Because the tech sector 37% allocation went, India just had 8.4%, and Indian tech sector now is perceived to be dead also. All right. We are going through some problems in tech sector. I also believe some of the CEOs and CFOs, not CFO, but CTO and CEOs have to be fired because they have not aligned themselves with the industrial trend. They are taking hefty payouts, hefty bonuses. Investors are getting nothing. All right. But at large, the smaller IT companies is where you have to see what is happening. The bigger ones, I think, are still caught sleeping. They need to think about their strategy. Probably when the AI trade will reverse, a lot of things will fall. Probably they'll go out and acquire some of these companies and try to align with the industrial trend. Hopefully that will happen. Now, India's weight. So this was the number I was talking about. It was 7.8 in 2020. I'm talking about post 2015-16 only because the economy before that was a bit different. We cannot compare. So currently, May 2026 filing, it is 11%. All right, domestic institutions are owning about 19%. FII is 14.7%. Yes, FII selling is going on, but it is normal. It is normal because last time also in one of my videos, I had recommended a book, Trading and Exchanges. Please read that book, at least on an audiobook or any medium that suits you, because there is a theory that is floating around these days that we, the SIP people, are providing exit to FII investors. This is one of the most absurd things you will read in stock markets. Again, it is floated by those who don't understand the technical side of how a trade is done in stock markets. So if you have some time in your life, read the book Trading and Exchanges. I think the author's name was Larry something. I've forgotten. I'd read that book many years back. That book shows you how institutions also work in stock market and why you should not be that worried, because it is a technical thing. If DIIs are providing money, somebody will exit. And it is completely normal. FIIs, if they are pulling out 8,000 crores a day, just ask any of the AI agents how much investment they today already have in our market. So this is a normal thing that is playing out, guys. For India to go from the emerging market share, which was I think 20% in September 2024, and it is now down to 11. There was also a time where the share was only 8% and it went to 20%. And FIIs were coming in large numbers. So these things are cyclical in nature. It happens. So this is the FPI flows that you're currently seeing. Again, this year is turning out to be brutal. And I don't think selling is going to end so soon. So please be prepared. Despite of the RBI measures, yes, some outflow will stem. But in general, the trend will remain because the first preference that FPIs will again give is to the tech sector AI trade, which is currently playing out, because some of them will finally see a pullback coming in the market and they would be interested in taking exposure because that is where things are great. Our nominal GDP growth has to pick up. Our large cap companies are still growing in single digit. Who's going to come to India to invest? The real growth story is playing out in the SMID space. That slide I'll put out. So this is the emerging market P ratio and India P ratio. India is converging, emerging market is rising. Again, India's premium over EM has reduced greatly from 88 to now, I think 30, early 30s or late 20s, 28, 29. I have usually seen when it reaches the 20 mark or 18 mark, that is when things begin to stabilize. So we have a couple of quarters more to go. The currency has been the biggest factor, and that is a well-known fact. 8.9% was Nifty's return in 2025, but when you adjust with currency depreciation, it was 4.3. It's even worse this year. Negative, I think 7% is now. This data is a bit old. Rupee has depreciated. The actual return is minus 10.1. So who is going to come? That is the problem. And this is a problem that is being addressed by Reserve Bank of India in the recent monetary policy also. I'll explain that in a bit. So this is India's rank by the year. So again, can you see how cyclical this is? Again, this is not some data that I'm making up. This is a data that is available. Things are always cyclical in stock market. Things are always cyclical in life. In life, you cannot always have ups. You cannot always have downs. You always have ups and downs. That is what stock market is all about. That is what India is all about, relative to emerging market or relative to world market. That data also I'll put up. So we were one of the worst performing emerging markets in 2011, 2012. We have again reached there. In between, we were the best performing in 2015. We had good rating in 2017, very good rating in 2020, very good rating in 2024, and now a bad rating. So this is India completing a life cycle. Again, things are cyclical. Always remember, for the serious audience here, it is data versus narrative. Always believe data. So in 15-year annualized returns, now India is, I think, 5th, 6th place. Taiwan and South Korea obviously have overtaken India just because of the fantastic AI theme that is going on. So when it comes to the relative strength of India versus emerging market and its peers, today relative strength has again reached this zone, the 80 to 100 zone. So in between 2014 to 2024, India was one of the best performing emerging markets relative strength wise. So there is some course correction happening. When you run 100 meters quickly, you take some time to cool off. When you run 400 meters, you take a couple of hours to cool off. When you start swimming or running interstate, intercity, you will need many days to cool off. It is the same logic for stock markets. So these are cycles that play out. So India has lost relative strength or relative market share against Taiwan, against Korea, against China, against Brazil. And that is why our allocation is now down from 24% or 22% in September 2024 to 11.9 or 11% in May 2026. Now, the real story of India, where it is playing out, it is in the SMID space. So this is the distribution of returns since 30th March to 2026, when global markets also started bottoming out after the war-related news that played out. How many stocks have rallied 100% since then? 37 stocks. How many stocks have rallied 50 to 100%? 262 stocks. How many stocks have rallied 30 to 50%? 469 stocks. And between 10 to 30%, which is again beating broader market, 954 stocks. So now, if somebody comes and tells you on television or somewhere there is nothing happening in the market, what is this? If they are not able to identify a 50 to 100% stock since March, or a 30 to 50% stock since March, or let's say even a 10 to 30% stock since March, problem is with their method and their mindset. There are plenty of opportunities that is currently going on in India. Please understand this. So headline indices are not doing great, and top 300 stocks are not going to do that great. But underneath, there are so many smaller themes that are working. How do you describe India's today's market? We will describe India's today's market as a very selective bull market, where majority of stocks, 55% of stocks, might not do anything. But there are these 40% stocks. Out of those, you have to identify these. So it's a stock picker's market today. It's not easy anymore as it was in 2021, 22, 23. But please don't believe this, that there is no opportunity. The biggest opportunities you will see in life is when headline indices don't do great. Because the sentiment is not great, people don't want to work. Everybody wants easy. Now, when I say everybody, I'm talking about non-serious participants. So please understand. And as it goes in life, anything that is easy does not last. So you have frameworks by Weinstein, by William O'Neill, by Mark Minervini, by David Ryan, by Peter Lynch. You can identify these stocks. If you go through 700 stocks, and from 700 stocks, you understand only 70 stocks. And from those 70 stocks, can't you identify stocks that are in beautiful structures, having sales growth, revenue growth, largely independent of global economy? Can't you identify that? You can, but largely we don't do that, again because of a theory narrative that is always pushed out that nothing is happening. It is not true at all. If somebody tells you that, ask them to show you the data. I'll tell you what data they'll show. They'll show one AI chart, they'll show currency chart. They will not show this data. They will not show data. We have had so many stocks since March that are remotely related to AI theme and have rallied like 100, 150, 200%. And then they will finish off their research by saying, you should be in XYZ US AI stock because see that has run up 50%. For that, I'll show you one data. This is that data. This is 2003 to 2014. People tell you today, right? 11 years, look what India has done. Look at this data. If they have the benefit of hindsight, you should also have the benefit of hindsight to counter their view. Between 2003 and 2014, India gave 15.7% in USD. S&P only gave 7.3%. 10 years, S&P 500 and Nasdaq was in a range. Was the American story dead? No. Today, India is in range. Is our story dead? No. And now, next 10 years, America has actually flipped the game and it has given 12.1. We have just given 5.6. Now, what is coming in next 10 years that is important? The only question you have to ask yourself today is, in the next 10 years, do you think that America or any other market is going to give you 15% annualized return USD? If yes, then you have your answer. Your money should be there. But if you believe in cycles, if you believe in things getting better after they get worse, if you believe in our demographics growth story, then you have a different answer as well. If today someone is telling you, and why I'm making this point, because especially in the last 6 months, there have been so many videos and tweets about why you should invest in America. Those tweets should be in 2014. In 2014, if you open Google News or you go back in feeds and see how many people were saying America is going to do well, it was all about India, trust me. Despite of the fact that we had a brutal 2011. In general, it was always emerging market is going to do well. Then suddenly developed markets started doing well. So whatever is doing well today, in today's language I'm talking, whatever is doing well today, around that topic only you are going to see tweets and videos and research reports. All right. So now the next slide. Now I'll come to the RBI monetary policy. I think it was one of the most bullish monetary policies we have seen in recent times. And it was fantastic that Honorable Governor, with his body language, communicated what he wanted to communicate. So the rates were held at 5.25%. They raised the inflation forecast. So inflation in India going up won't be a bad news, I'll tell you. If you look at our economy, the GDP is growing. It is the nominal GDP growth that was not there. I think nominal GDP growth historically, whenever large caps have done well, was between 11 to 13%. Now it was in single digits. And if inflation slightly pushes up, if the nominal GDP growth comes back, you will see things changing pretty quickly. This should not go out of hand, and I don't think it will, because as of making this video, I was seeing UK oil was down to 92 or 91. So oil is not able to break through that 9900 barrier now, when reports were coming out that oil is eventually going to $150 or $160. GDP growth has been reduced to 6.6%, which is also fine. We are still one of the fastest growing economies in the world. There are some things we need to fix that I think we are beginning to fix. The recent GDP data was also really positive. So the concern point, of course, was our currency. And I think governor has done enough to address this issue as well. So they are working on 5 major things. So the FAR has widened. You can use any AI agent to understand these things. These are fairly easy. They have given tax break. They have changed the limits for NRI and the OCIs, made hedging relatively cheaper, and then, of course, working towards faster exports. So I was reading one of the reports where there was estimated that this move can have a potential of bringing back $35 to $45 billion. What we are currently seeing on a daily basis is, I think, 7,000, 8,000 crore outflow every day, at least from equity market standpoint. That is roughly $800 million. And this is not going to stop, guys. It is not going to stop paying attention to the FII money. If you pay too much attention to FII money, you will never be able to see what is happening in our small and mid cap space. Pretty soon you'll also start to read that all these SIP investors who are putting money in small and mid cap space, eventually that space is also going to collapse. Well, let me tell you one thing, anything can collapse any day, you know. But look at the earnings. In the recently concluded earnings in our market, while large cap companies were growing in single digits, the SMID space on an average median growth was 28%. Sales growth, revenue growth, profitability, that is a super healthy number. So that is why that particular pocket is going up and the large caps are not doing well. And this trend, I don't think is going to change so soon also. The reason I say so is because, look, there will be a lot of institutional investors also who did not get to participate a lot in the AI trade, in the semiconductor trade, and they are finally going to see this as a buy and dip kind of opportunity. That is why they'll keep pulling money out of India and emerging markets and general assets that are not doing well. Money is flowing from crypto, money is flowing from gold, silver. Everything is rushing towards the AI semiconductor trade. So I don't think that trade is over. This is going to be an amazing opportunity for people who can invest in these particular trades if they know how to identify which particular stocks they need to target. But relative to EM, I think India is going to go down more. I think more outflows are coming. Our DII investors will have to step in and support the market. This is a trend that won't reverse. And one final day, when I don't know how many quarters down the line, when India becomes really cheap in terms of growth picking up, nominal GDP again, growth coming back, earnings acceleration that happens. That is when we might start getting attention again. See, earnings acceleration means people nudging each other abroad and saying, "Hey, look at what is happening in India." That nudge won't come with this single digit growth in large caps. Remember, FIIs generally, if you look at their ownership, they have 20% plus in large caps, then I think 16% in mid caps, 12% in small caps, and I think single digits in micro cap. Micro cap data is actually very sketchy, so I can't put a number, which means they need to see top 300 companies delivering double digit fast paced earnings growth. That is just not there in India. You have to accept that. And that is the reason why we'll continue to see some outflows. Whatever measures RBI has taken, it is going to take some time for those measures to come back. One of the prominent, let's use the word market commentator. I don't want to categorize that person because it will be very easy to identify. He's associated with some network and I don't want to name. Wrote that, look, RBI did this thing and today there was outflow again. I mean, these are such ill-informed statements because they don't even know how institutional desks work. You need prior approvals, prior permissions. There is a pipeline. Things have to be worked out. That is when trades are done. It is not done after 5 minutes of policy announcement. So the sentiment, the pessimism that is there around India is just mind blowing. Some of it is rightly placed, but some of it just doesn't justify so many good things that so many entrepreneurs who have listed their companies are actually doing in India. And that pocket is in the SMID space only. You can find companies that are growing in higher double digits, 40%, 45%. You can go to screener.in and just find out a list of those companies. I cannot, of course, name companies here, but it is not that difficult to figure it out. You don't have to see the Indian stock market story just through top 200 names, which are actually growing in single digits. Some of the investments they are doing are completely misplaced. They can use the capital better. They can invest more also in our own story. But that is something that is still not happening. So we will continue to struggle. But if people are pulling out a lot of money from the AI trade, initially we'll also take a hit, but we will stabilize because we don't have the froth. We don't have too much of money related to this trade. We will continue doing what we are doing. Today we are not doing that great. Next couple of quarters also can be relatively lull also. But at least there is no froth in the market. That is what I want to tell you. So the pain is going to last. But structurally, I would tell you India is fine. We are going through some cyclical stuff that we've been through in 2005-6, in 11-12, in 17-18. This is just another those kind of phases after the wonderful phase we have seen in 2021 to 2024, which a lot of people have forgotten, or probably they've gotten used to so much of this phase that they don't want to see these phases coming up. Again, as it goes in life, things are cyclical, and this is how things play out. So have a great weekend ahead, guys. Take care, be safe, and please make sure your comments come in today because for today, I'll definitely keep the comment section open and I'll try and reply to all the queries. Take care and be safe.